cut right through the noise. This is your signal-focused briefing, and we are going to break down the essential intelligence that's actually moving the markets right now. Ready? Let's jump in.
So, here's our game plan for today. We're going to start with the Fed's big pivot, then dig into what's really going on with the US and China. After that, we'll tackle the red-hot AI sector, scout out where the real opportunities are hiding, and then tie it all together with the key takeaways you need.
First up, let's talk about the Federal Reserve, because, the whole story here has changed. They've shifted from a pretty clear path to, well, something a lot more unpredictable.
So yeah, the Fed gave us the 25 basis point rate cut everyone was expecting. No surprise there. But, and this is the real kicker, they basically slammed the door on the idea of another cut in December. And that changes everything. The market went from thinking rate cuts were on autopilot to now we're just kind of drifting, waiting for the next piece of economic data to tell us which way the wind is blowing.
So what does this actually mean for you? Well, get ready for some choppy waters. Those days of just betting on the riskiest, high beta stocks and winning big, they might be on pause for a bit. The spotlight is now swinging over to quality. We're talking companies with real cash flow and strong, reliable earnings. It's a time for a smarter, more strategic approach to risk.
And that brings up this really key concept, duration timing. Now, it sounds complicated, but it's not. All it really means is figuring out the perfect moment to move your money from super safe short-term cash into longer-term bonds, to lock in those better yields before rates change again. And with the Fed being so vague, getting this timing right is more critical than ever if you're invested in fixed income.
So the big question, how do you actually play this? Well, with bonds, the smart move is probably not to go all in at once. Maybe stagger into those 3 to 7 year treasuries. For stocks, we said it before, but it's all about profits and resilience. And for other stuff, like crypto, that moves with interest rates, you gotta be tactical. That recent rally could fizzle out pretty fast thanks to the Fed's new tone. Okay, let's shift gears and talk about our second major theme, the ever-complicated dance between the US and China. We're hearing a lot about de-escalation, but let me tell you, that does not mean we have certainty. Far from it.
You really have to look past the headlines on this one. On the surface, things look a little better, right? We're hearing about tariff trims, talks are back on, but when you dig deeper, the reality is much messier. You've still got influential voices demanding major tariffs. And these new agreements have huge exceptions, like blocking the sale of NVIDIA's top-tier chips to China. That risk of policy whiplash, where things could just snap back in the other direction, it's still incredibly high.
So what's the bottom line here? The good news is that the nightmare scenario, a full-blown, all-out trade war, seems to be off the table for now. That's great news for supply chains and exporters. We call that lowered tail risk. But, and this is a big but, don't get too comfortable. The underlying tension and volatility are definitely still there. This is not the time to ditch your hedges.
All right, you knew it was coming. Let's talk about AI stocks. The story here is a classic tug-of-war. The long-term fundamentals look amazing, but they're clashing with some seriously overheated, kind of scary valuations.
Let's start with the bull case, because it is a strong one. That AI demand flywheel, it's spinning faster and faster. You don't have to take my word for it. Just look at the blockbuster earnings from Microsoft, Meta, and Google. They are pouring billions into AI infrastructure. That proves the long-term story is for real.
Okay, but now for the reality check. Look at this chart. This is basically a giant flashing warning light for the short term. It shows that the main semiconductor ETF is trading way, way above its long-term trend line. I mean, the gap between the price and its average is the widest we've seen since last July. And you know what happened last time it got this stretched? Chip stocks dropped 30%. Ouch.
So with a setup like that, you have to be smart. You can't just chase everything. Maybe it's time to fade the most extreme moves, maybe using options to manage your risk. Be patient. Have a shopping list of high-quality AI names ready to buy if we get a dip. Or think about a barbell strategy. You can own the big, safe platforms, but also own the second derivative plays. The companies that build the data centers and all the other stuff the AI boom needs to run on.
So the big picture is messy, the Fed is uncertain, AI is stretched. Where on earth you find an edge? Well, that brings us to our next section, finding alpha. Or put another way, why picking the right stocks is way more important than just betting on the whole market right now.
The key thing to understand is that it's less about the whole market going up. That's what we call beta, and a lot more about finding individual winners. That's alpha. It's a true stock picker's market. Why? Because different companies are performing very differently. A killer earnings report from a company like Align Technology can make a stock soar, even if the broader market is just treading water.
So let's get specific. In the credit markets, believe it or not, high-yield junk bonds are actually less volatile than stocks right now, which makes them an interesting tool. Over in medtech, a great earnings report can completely overpower any macro fears, so it makes sense to trade around those individual company results. And check out energy. There's a real disconnect. The stocks look solid, but the future for crude oil is murky. That sets up a classic pairs trade. Go long on strong energy stocks while staying neutral or even short on crude oil itself.
Okay, we have covered a ton of ground, so let's boil it all down. If you remember nothing else from this briefing, remember these 4 things. This is the signal through all the noise.
Takeaway number 1, the Fed. The old cuts on autopilot idea is gone. The new mantra is data-dependent drift. That means timing your move into longer-term bonds just became a critical part of the game.
Number 2, US and China. Don't let the happy headlines fool you. Underneath the surface, that policy whiplash risk is still very real. Things are less dangerous, maybe, but they are a long way from being stable.
Third, AI stocks. The long-term dream is absolutely alive and well, but the short-term reality is that valuations are sky high and looking dangerously stretched. So be smart and be careful out there.
And finally, number 4, which ties it all together, your strategy. This is not a market where a rising tide lifts all boats. It's a stock picker's market. Finding those individual gems, that's how you generate alpha, and that's where the real wins are right now. So there you have it. We've laid out the map, pointed out the opportunities, and highlighted the risks. From the Fed's drift to the strain in AI stocks, you've got the lay of the land. The only question left is, how are you going to navigate the noise?